Welcome back to the Kaiser Report. I'm Max Kaiser. Time now to turn to Mark Armstrong of publicbanking.org. Mark, welcome to the Kaiser Report.
Hey, Max. Good to be here.
All right, Mark Armstrong, let's talk first about the banking system as we currently know it. First, the FDIC, it protects our deposits, right?
It is insurance for protecting our deposits, but the insurance fund is only about $27 billion. Deposits are way over $1 trillion. So in light of the derivatives bubble, which goes up to about 10 plus trillion just for at risk, just for B of A and Chase, there could be a real problem.
All right, we'll get to derivatives in a second, but let's just revisit those numbers for a second. You're saying there's a roughly $1 trillion on deposit, and the FDIC fund has how much in there?
About 27 billion.
Okay, when we look at situations like what we saw recently in Cyprus, where they had a bail-in, here you have a situation where deposits from people with money at the bank was basically confiscated by the government.
Right.
And so when you describe a situation where the FDIC has a minuscule amount of funds available in case of some kind of meltdown in the financial system, which is almost 100% guaranteed to happen in the relatively soon basis, are we saying therefore the U.S. would be a prime candidate for a bail-in type situation?
Right, because according to Dodd-Frank, we're not allowed to have taxpayers bail out the banks. So when they go bankrupt, what are they going to do? They're not treated with the same rules that a normal business has, where when a bank goes bankrupt, assets are dispersed. They get to seize deposits and turn depositors into shareholders, and then continue business.
Okay, so there's another big point here, which you cover over there at publicbanking.org, along with Alan Brown, who's a big fan of our friend, I should say, of our show. Does a depositor own his or her deposit?
No, they don't.
So explain that exactly. If I give the money to HSBC or Citibank or some big bank, and I put my money in the bank, don't I own that money?
No, you become a creditor of that bank. The money is owned by the bank, and that they treat that as a liability. They owe that money back to you. Has
this always been the case?
Yes.
And is there anyone out there trying to reform this other than you? Because you have the obvious conflict of interest. If things go bad, the bank simply says, well, these are our deposits to begin with, and you got to get in line, and you got to get in line behind a massive number of creditors.
Right. Well, I think 2008 was a big wake-up call for the general public in America and elsewhere, and people are realizing that the banking system has all sorts of fraud baked into it, and we've been told one thing, but the reality is another.
So there's fraud baked into the system. It seems as though the fraud recipe is being shared amongst various banks and institutions, and you have a plague of fraud. To me, I'm curious what your comment is here. Back in the 80s, you had the savings and loan crisis. And what happened was that banks were extending certificates of deposits to folks, knowing that they couldn't possibly repay those certificates of deposit, because knowing that when they were unable, the federal government would have to come in and make good on that claim, so they were gaming the system. In the wake of that scandal, instead of the government or somebody, coming in and imposing regulations that would prevent that from happening, it seems as though the banking lobbyists in America figured out exactly how to lobby to change the law and to create new laws, so when they did the exact same thing again, they would not go to jail as over 1,000 did last time. Is that an unfair characterization?
No, that's absolutely fair. And the thing what's happened is that even regular law like bankruptcy law they're treated special. So when a bank goes bankrupt, they get to seize depositors' funds and turn that into capital. And no other business has the right to do that, but banks do.
All right, let's talk about the $700 trillion in derivatives outstanding. In the event of bankruptcy proceeding, who has priority, the depositor or the derivatives wielder? I guess we've already kind of answered that.
Derivative claimants, yes.
And the $700 trillion, you mentioned that there are $1 trillion in deposits backed by minuscule amounts of insurance at the FDIC. $700 trillion in derivatives, of course, is against a global economy with only approximately $60 trillion in GDP. So is it unfair to say that when Hank Paulson goes to Congress and says, give us $1 trillion for TARP, that he's being extortionate and he's wielding the weapon of we'll collapse the system using derivatives unless you give us our cash? Is that an unfair characterization?
No, not at all.
Let's talk about what your group does. How would a public bank And of course, I'm talking with Mark Armstrong of publicbanking.org. How would a public bank address the problem with this model?
So the premise behind the Public Banking Institute, of which I'm a part, Ellen Brown founded it along with a dozen or so other people, is that virtually all of public finance has been co-opted by private financiers. So there's no true public finance in the U.S. anymore. In virtually all, 49 of the 50 states, public dollars, tax receipts, fees, are deposited into private banks, and that begins a set of dependencies so that public officials are wholly dependent upon the private financing world. And public banking is all about putting those deposits, and it's over $1 trillion of deposits, into public banks, government-owned banks, which are then use the capacity to create credit to fund bridges, to fund schools, to fund things that can be paid back and that we need.
It seems that the banking industry is remarkably simple. When I was working on Wall Street, there was the old 3-6-3 rule, which is you pay out 3%, and you lend at 6%, and you're on the golf course by 3. But there's an amazingly simplicity to this model of banking that you could say it's almost a utility. That the utility industry, to make sure people get power, to power up the economy, to power their homes, has been regulated for years because you don't want private enterprises gouging the price of energy because it's completely malevolent to the entire economy. Banking, similarly, it's a very simple business. It's a utility, and yet none of those utility banks exist anymore. They've all been purchased by these super infrastructure mega banks. It's all been privatized. They are leveraged 50 to 60 to 1. So what you're saying on the surface, to those who forget the history of banking, will say, wow, that sounds like you're turning your back on free markets. You're turning your back on capitalism. You're returning to some kind of government interference. But that's completely false. You're just returning banks to from whence they came. It's a simple business. Doing a simple activity, it should be simply organized.
We look at water, we look at electricity, transportation, mail. All those are utilities, and the creation of money is definitely a utility. Of all those utilities, it's probably the most important. And we look at each one of those markets as a place where you want to regulate industry, and you also want to provide a public service. So you have water coming out of the tap, you have electricity coming over the wires, you have mail delivery service, at least we used to. It's being privatized here as well as in the States. And so when you look at public finance, it's been completely privatized, where public finance officials need to go to the private market to obtain relatively low-cost funds. But even in California, there have been capital appreciation bonds being sold over the last 7 years. $9 billion of principal has been financed, and the cost on that's going to be $27 billion in interest. So we're being gouged in the public finance world, and public banking is just an alternative to finance that ourselves without going to the private markets.
What I don't understand about Americans, if I can use the term, broadly in this sense, but they seem to like and understand how Walmart uses its size to pressure suppliers to get cheap stuff. But they don't seem to get that the size of the government can be used to pressure suppliers to deliver cheap banking, cheap health care, cheap transportation. In other words, the biggest beneficiary of having the government act as to negotiate good prices in a Walmart-like fashion are the people. The people would benefit from this. And yet they're the first ones to step up and say, no, we don't want cheap prices. We want to pay through the nose. We want to be gouged. We want to be raped. Why is that?
The whole notion behind banking is that it is a simple business, as you're saying, and what gives the bankers the right to extend credit is the banking license, which is issued by the state government typically, and yet state governments disenfranchise themselves from having that same license to have a seat at the table to access low-cost funds, which is what is needed in order to better finance schools or bridges, whatever. The Bay Bridge just reopened up. It's a beautiful bridge. I just went on it for the first time 2 days ago, but it costs $6.4 billion in materials and services. It's another $6 billion in interest charges. But we held labor under the microscope while it was being built. We never looked at the financing for it. and yet it doubles the cost.
Yeah, this is, again, as we touched upon, as we do on this show often, is that GDP is calculated by taking into account all of the misinvestments that are made by the investment community and the interest costs that they pile on to all of these projects. However, when it looks at inflation numbers and why that should be adjusted to labor, then of course everything is deflating in value. So if you're working for a living, it's always about deflation, and Ben Bernanke needs to keep interest rates low to help you. But if you're a banker, GDP is great, and I need to pay myself an enormous bonus. Right?
Yeah.
Now,
exactly.
we have a couple of minutes left. You touched on this briefly. I want to get into it a little bit more. Give us a sense of how the public bank would look like. For example, how would it reduce debt servicing costs? Okay, you're getting into this now, and I wanted you to probe a little bit deeper, because the interest cost in this economy is the killer. It's ratcheting it up in ways that if interest rates were ever to resume a normal rate of 5%, which is the post-war normal rate of a 10-year bond, would be 5%, not 0.5%. So if we ever return to a normalized interest rate curve, then interest costs would go up 500% or more. And no one seems to be protecting the public against this. They're just adding more and more debt to fill the pockets of Goldman, JP Morgan, HSBC, and Barclays. So talk a little bit about, I think.
Sure.
Yeah.
So I'll just use an example. Bank of North Dakota is a public bank. It's the only public bank in the United States, and it does financing for infrastructure. So it financed a water pipeline in the western part of North Dakota. It put in $50 million to fund that. And let's just think about the mechanics of that. What's happening is the water payers are paying for the interest on that. It doesn't really matter what the interest is, because whatever interest they pay goes back to the bank, which is owned by the people, and then that money is recognized as profits and returned to the general budget to lower taxes or to provide increased services. So you end up with this closed circuit. So it doesn't matter what the interest rate is, frankly, in a closed circuit like that, because the people may pay the interest, but they're going to receive it back in terms of profits. So that's the value proposition behind a public bank is that it returns the interest to the same economy in which it was paid.
During the financial crisis, the North Dakota Bank, what happened?
Their return on equity was 25% that year, 2008.
So they didn't go down, they thrived.
They thrived, and their return on assets was approaching 2%. So yeah, they did great.
So here you have a model.
What's interesting about public banks is they're countercyclical. So some of our material comes out of Latin America, and there are a lot of public banks in South America, and they've done studies, and one of the most recent studies showed that all their banks actually grew during the recession. Same with Bank of North Dakota.
So they're actually doing what you'd expect in any healthy, balanced economy or ecology, is that when one area goes down, another area makes up the cost.
Exactly. Yeah.
What we have now is that since all these banks are trading on the exact same thing at the exact same time with the exact same leverage, when it starts to blow up, they all blow up.
Right. And then it's a systemic failure. But public banks are really a hedge against that.
All right, fantastic. Mark Armstrong of publicbanking.org. We're out of time. Thanks so much for being on the Keiser Report.
Thank you.
And that's all the time we have for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Mark Armstrong of publicbanking.org. If you'd like to get in touch, tweet us at Keiser Report. Until next time, Max Keiser saying bye, y'all.